All right, welcome to another edition of the Trustcast Show. I'm really happy to have with us Ken Himmler. Ken, welcome to the show.
Well, thanks, Zane. Thanks for having me on.
So, Ken built one of the country's first home inspection companies in the 1980s, flipped over 70 real estate deals, and now co leads a firm with $840 million under advisement, all to prove that successful business owners should keep far more of what they earn. So, Ken, you invented something called the Rothinator, which promises to legally eliminate taxes in retirement. How is that even possible?
Well, I think we all know what a Roth is, but I also think that a lot of people are misled. The financial industry is absolutely intent on convincing people not to do Roth conversions. And people ask me all the time, why? Well, if you think about it, if you've got, a billion in your coffers and you're an asset management company and you told all your clients to convert to a Roth because it might be better for them, it's going to be terrible for the financial company because now they
Mhm.
may lose 2 to 300 million in assets under management because it might have gone to pay the taxes. So what I find is a systemic problem in that financial advisors don't want to lose assets under management because then they got to go to their boss and say, hey, I lost 20, 30%. Why'd you lose that? Well, I told the clients to do what was best in their interest. Well, that's not going to fly for most people. So there's this campaign, a silent campaign. It's like a shadow campaign against doing Roth conversions. Now, I've been doing Roth conversion analysis since 1996 when they came out. We've done over 1,000 of these things, and typically we would charge anywhere between $6,000 to $8,000 to do it. And when I learned about ChatGPT about 3 years ago, we started building a AI model that would do it. So to give you some idea, one Roth conversion analysis would typically take my advisory team 20 to 25 hours to do all the different formulas and all the different computations. Now we can plug that into the AI and it does all those computations. The goal of moving to tax-free strategies, and Roth is just one of them. The privatized asset loan is another one. Borrowing against assets is another one. There's a lot of different techniques to get to a tax-free life, but the Roth is probably the most popular because it's the most well-known and understood. And by studying the different methodologies of how to do a Roth, whether you do it by bracket fill, lump sum, fixed period of time, and do you do leverage against it so that you may not pay as much tax or no tax? So I'll give you a real good example if you want, Zane. So we had a client come to
Okay.
us with about $1 million in an IRA and late 60s. And I asked him, why haven't you ever done a Roth conversion? Well, I don't want to pay the tax. I said, well, let me ask you a question. Even if the tax that you paid, because look, an IRA is essentially like a house with a mortgage on it. You got an IRA, but you got a tax lien on it. So everybody looks at their IRA and goes, oh, I had $1 million. You don't have $1 million. You got $1 million minus what you go on the tax. It's not real money. So I kept explaining this to him. It just, I don't know, the mental hurdle of him saying, hey, I got to write a check for this amount of money. Even though he's a smart guy, he just couldn't bring himself to it emotionally. So here's what we did. We created something called a 664 trust because he had a lot of intent for charity and setting up a family foundation. We took 2 of the 5 million that he had, we put it into the 664 trust, and it gave him $1 million deduction. Then he was able to convert the $1 million completely tax-free from his IRA to his Roth. And so there are techniques that they don't work for everybody, and everybody can't do what I just explained, but maybe there's other things that you can do if you have a qualified advisor.
So, if you put your money into a Roth, why would you lose the ability to manage that money as a financial advisor?
Well, if you think about a typical financial advisor, let's say they have $1 million client, and let's say all that money is in an IRA. And let's say that that advisor is really intent on doing the best thing for the client. They do the calculations and they say, listen, it's best for you to convert this. Let's say that the average tax bracket of the conversion of the $1 million to the Roth is 25%. Where's the 25% come from? It's going to come out of those assets. So instead of the advisor charging 1% on a million, now they're charging 1% on $750,000. So most advisors, right off the hip, without And I always laugh about this. Clients will say, well, I called my financial guy and he told me a Roth's not a good idea. And I'll say, how fast did he answer that question? He answered it right out of the gate. And did you ask him why? Yeah, because you don't want to pay the tax. You're going to lose assets. And I said, that's such baloney. You may not lose assets because you didn't have them to begin with if there was a tax lien on the IRA. You didn't own the money. So how did you lose it of something you didn't own to begin with? But the advisor doesn't want to do it because guess what? Now he's charging 1% of 750,000 instead of 1% of $1 million.
So if let me take the devil's advocate side, which is okay. Well, I've got my money there in the 401k or whatever, and I don't want to pull it out because then I'm going to pay taxes on it when I pull it out. But I just want to pay taxes on it when I pay taxes on it. So it will be whatever portion at that particular time. Let's say you're on a limited income and you have X amount out of your, but if you pulled it all out, then you'd pay the higher rate. But if you pull part of it out, you're going to pay the lower rate.
And that's not wrong. So I can tell you statistically out of whatever it is now, 30 some years we've been doing this, is that it doesn't work for everybody. Out of 10 analysis that we do, there's only 7 people out of those 10 that a Roth works for. 3 out of 10 it does not, because they fit into the group that you just said, the fixed income, lower income. You can take the you can take the IRA distributions and the RMD still in a low bracket. But here's the interesting fact. Most Americans have had the wool pulled over their eyes with financial propaganda promoted by the financial companies. You know, one of the largest companies in the country with $3 trillion under management did a study about 5 years ago. And what they found out is that people are 79% less likely to take money out of an IRA than they are out of anywhere else because they got to pay the tax. So if you're a financial institution, what do you want to promote? You want to promote 401ks, you want to promote IRAs because the money will stay in there longer because people don't want to pay the tax, which means you get to collect fees longer. And the last thing you want as a financial institution is for people to start taking out 20, 30% to pay the tax. So it's really poo-pooed on by most of the big financial institutions. And then they push that down to the financial advisors saying, hey, let's not do this, or we'll limit your education on this, or we'll limit the software that you use to do the correct calculations. But you're right. There's about 30% of people it does not make sense to do it for.
Okay, fair enough. So let me ask you some business owners. So you have quite a bit of clients that run businesses like doctors and lawyers. I when I did the research on this. So let me ask you some questions from their perspective. So I'm running a profitable business. Why does it feel like I never actually have any money?
I'll go back to good old Ben Franklin. Okay. Failing to plan is planning to fail. It's because most business owners, they're really good at what they do in their business. Unfortunately, an over exuberance of confidence transcends into failure into their profits and what they do with their money. And just because a business owner can hire people and successfully manage them, and just because they can sell a widget for a profit, does not mean that they know how to handle a balance sheet, investment strategies, capital allocation, EBITDA growth, any of those things that really are going to put more money in a business owner's pocket.
So my CPA files my return, says I'm in good shape. Why do you say that's not enough?
Well, because we actively buy CPA firms, so I'm not knocking CPAs, but I can tell you exactly what the mentality of the CPA is. So we just bought a CPA firm with about over 1,000 clients. And when I inspected what this CPA was doing, it was very typical. And I'd say, his name was Joe. And I said, Joe, why aren't you doing any in-depth tax planning? He said, well, I do tax planning. Well, tell me what that looks like. Oh, I call the clients up that have enough money, and I call them up in November, and I'll say, maybe buy a car or put more money into your IRA. And see, that's the mentality of a lot of tax planning CPAs. That's the extent of it. And when you talk about real tax planning, you're talking about something that's done month to month, not at the end of the year. The problem is when I went to Joe and I said, Joe, why aren't you doing any proactive tax planning? Oh, I don't have the time to do that. Well, why didn't you charge the clients? He goes, I try to charge the clients. And I said, what'd you try? How'd that work out? He said, well, I'd go to the clients. I'd say, listen, I'll follow your monthly taxes and figure out tax planning. Well, what's that going to cost me? Well, $2,000 to $3,000 a year. Well, I don't want to pay that. And I've experienced that same thing. So there is a wall between tax preparation and tax planning. And most CPA firms are not doing proactive tax planning. It's reactive. So it's not enough. Because look, what's the biggest expense you're going to have for your entire life? It's income tax. It's going to be more than the house you buy, the kids you educate. It's going to be the biggest expense. And if you're like an Elon Musk mentality of, hey, efficiency, 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 why aren't more people focused on reducing their taxes and deploying that capital in much better places?
What does tax planning look like for a small businessman who's, being fairly successful, or even one who isn't being so fairly successful? What's give me a few keys behind effective tax planning that a regular accounting firm is missing out on?
Oh, well, good question. It's just, first off, I'll tell you, it's about structure. If you talk to 9 out of 10 CPAs, they're always going to tell you, set up an S Corp. That's because that's just the culture is uses S Corp. We unfortunately even have a lot of tax returns that we do in our tax planning practice, and the CPAs have just kept them as a regular LLC or a regular sole proprietor, and that is absolutely terrible. It's over. First off, you have all the liability. Second off, you're paying 15.3% in FICA taxes on your earnings. I know you get a deduction on half of it, so it's about 13.3%, but it's still 13% that goes out the door. The problem is in the structure, because the minute you bring up a C Corp as a planning technique, what most CPAs will say is, oh, I never use those. Why not? There's two particular reasons why CPAs, a lot of CPAs, not all. I've had the honor of meeting with some really sharp CPAs, and they're like, we share the same frustration in that, hey, this is just a lack of planning. But what the CPA objection is, well, you're going to pay double taxation. Well, how do you pay double taxation? Because the C Corp pays the tax on it, and then if you provide it out as a dividend, you pay a tax on it, and the C Corp doesn't get a deduction. So essentially it's double tax. However, in 42 years of doing this and all the C Corps that we've set up and run, there hasn't been a single instance where a client has ever paid double tax, because you don't run it that way. That's like a neophyte way of looking at a C Corp. The second objection CPAs have is, well, you can't really retain earnings, because that's one of the benefits is, if you retain the earnings that you don't need instead of paying it out as a dividend, then you're letting it sit in there and grow without taxation with it to you personally inside the C Corp. And then when you sell it, you can get a capital gains tax treatment versus income tax treatment. Or if you die, you can pass it on with a step up in basis. So the biggest objection is, well, you can't have retained earnings. That is ridiculous. Look, Apple is sitting on close to $900 billion in retained earnings. And the CPAs will say, well, if you have, more than $1 million in retained earnings, you got to pay a 20% penalty. Apple doesn't pay a 20% penalty. It's a matter of just filling out an annual, let's say a projection, and saying that money is going to be used for growth, investment in growth, acquisitions, whatever it is. That's how Apple has $900 billion. They don't pay 20% surcharge on their retained earnings. So the problem is business owners just take it upon the CPA's advice and says, oh, just create an S Corp. And that's all they do. They never look at multi-tiered structuring. Multi-tiered structuring means you might have a C Corp as a holding company or a management company. You might have an S Corp as an operational company. You still have to protect against the brother-sister rules that the IRS has, but by setting these up correctly with the right agreements and the right structure, you can get the benefits of both of those. So I think the business owner's plight, it starts with structure. But then the second plight is measurement and management. And, Peter Drucker said it the best, that which cannot be measured cannot be managed. And so most business owners have no idea what the KPIs and the numbers are that they need to know. They look at how much did we sell, how much do we spend. There's so many more numbers within a business that can be recognized. Okay, that's number 2. Number 3, they're just not finding the right people. I talk about the level of coaching. And when you said when the business owner, maybe a new business owner, well, look, if you're a new business owner, you don't need tax planning. You don't have any taxes. Now, when you start earning $1 million, $2 million, and you start seeing 50, 100, 200, $300,000 or more going out the door, that's the time that you need to upgrade your coaching. What I mean by that is we all know, most of us played Little League or something like it. And, when you play Little League, you get a Little League value coach. And then you move up to high school, better coaching. Move up to college, better coaching. Move up to the pros, the best coaching. What most business owners do is they hire low ball accounting and financial people because that's all that they can afford when they start. But they stick with those same people and they wonder why they're not getting the advice. Yeah, you have a Little League coach. As you start to grow your business, you have to upgrade your level of coaching. So give you an example. We just met with a business that is doing $10 million a year, and they have the same accounting staff and CPA that they did when they started. And here's what this CPA is missing. No multi-tiered structuring. They're all running it out of an S Corp. They have never had an R&D study done, and they clearly qualified for an R&D rebate over $150,000. They never had cost segregation done. They never had a benefits structure where they can actually deduct, like most companies will set up a 401k. That's kind of the known, right? And what companies don't realize is that when they're making a contribution to the 401k, they're paying the 7.65% in FICA taxes. It's not like a normal pension plan where you can contribute it and everybody saves on FICA taxes. You set up a 401k, the owner and the employee are both still paying FICA taxes. And the bad part about a FICA tax, it's not a deductible expense to the employee. It is to the business. But if you're an employee and you're putting all your money into a 401k, you're paying 7.65% in FICA tax and you don't get a deduction on it, which means if you're in a 30% tax bracket, it's more like paying 9 or 10% because you don't get a deduction on it. So there's these systemic problems all the way up the ladder with a business.
So walk me through what happens when a new client comes to you. What's the first conversation actually uncover?
Well, I think this is a little bit different because I've been doing this so long, 4+ decades. And the firm that I owned from, what would that have been, 1991, something like that. I started in that year. I had it for whatever it was, 25, 30 years. I sold that in 2014 to a private equity fund. And at that point, I had more money than I knew what to do with. So when I started this firm, everything I didn't like about the firm that I sold, I wanted to retool it. And so what most financial people will do is they'll say, well, let's do a discovery meeting. Let's find out what you have, what we can do physically, and saving you money. Ours is a little different. We actually just do a culture fit meeting. And one of the reasons is at my age and after this many years, quite frankly, I don't need the money. I just want to fix problems with people I like fixing problems with. And so my entire team, we have five financial planning teams, in addition to our accountants and CPAs. They're all the same way. This is the culture we have. If you're not nice and you're not humble and you don't want to fix problems together, find somebody else. We're just not doing it. It doesn't matter what the money is. We've had $100 million people come in and they're not nice. Say, have a nice day. Because unless you're nice and humble, I can't help you. And then the second iteration is we now move on to, let's look at the financials and a cost benefit analysis. So if we're going to charge you, $25,000, we're going to save you $26,000. It's a waste of time for everybody. But if we're going to charge you 25 grand, we're going to save you 100 grand. That's a good basis for a relationship. So it starts there.
So what is the Rothinator and why does it work when a standard Roth IRA doesn't get you all the way there?
So let's talk about what the fraud is that's going on in the typical financial marketplace. If you go online and you type in free Roth calculator and you type in your numbers, first off, most of those calculators are not built with true taxation in how your tax returns are built. Great example is we looked at Schwab's, we looked at Fidelity's, we looked at Vanguard's. Every one of them has input your tax bracket. Now, for those people that are financial people, you know that that's the most inefficient thing that you can do. How can I do a correct calculation to make a correct decision if I'm putting in my average tax bracket? It changes And so we built our program based off of a tax return. So when we use the Rothinator, we're putting everything in, and it's literally doing the tax returns every year, deciding whether you claim standard or itemized deductions, whether you're going to hit IRMA tax, NIT tax, AMT, what your taxable Social Security is going to be based upon modified adjusted gross income. It's literally doing that tax return every year. And then what it's doing is it's fitting in what does a Roth make sense? Does a Roth make sense each year? Some years it may not. Some years it might. And that's the difference at the top level. But then since I've been doing this so many years, I've seen so many different combinations of how life happens. So you do a Roth calculation online, and 9 out of 10 will pull the wool over your eyes, because what it'll say is a Roth does not make sense because you have a 15-year break-even period. Or Roth does not make sense because look at your net worth after 5 years. Here's your net worth in the IRA, and here's your net worth in the Roth. They're forgetting the IRA still has a tax lien. It's not worth this. It might be worth this. So we've done the deep analysis. So we're giving people the right answer. Not only do you do a Roth, but how much and the way you do it. But then there's other levels. So I'll give you an example of that. We've had a lot of people come to us. We do the Roth analysis. And we show them that while they're alive, the Roth has very little benefit to convert. Now, if they went to the typical financial advisor, the advisor say, yeah, don't do a Roth conversion. But see, there's more to life. There's different combinations. It's not just about projecting out a husband and wife for the next 20 years and will a Roth make sense? Because let's look at it this way. Let's say a husband and wife, I just left a meeting like this. Here's a great example. Husband and wife, husband has $2 million in assets. Wife has none. Wife doesn't handle any of the finances. And we looked at his Roth conversion on $2 million, and it had very little benefit over 10 years. It was only about $300,000 of benefit over 10 years. It's not a life-changing amount. However, now we ran another analysis, what's called first to die. So now we said, okay, what if you died in 1 year? Now what are the repercussions? Your surviving spouse now has all of the assets, but here's the difference. They're going to file single, whereas now you're filing married, filing jointly. Your tax rate is going to go up substantially. Now that benefit was another $600,000 over the same studied period. Now there's a third layer to this. Some people in this current generation, because I've been doing this so long, if you ask me, 40 years ago, parents would come to me and they'd say, the number one goal is for me to leave as much inheritance as I can to my kids, because they were raised in the Depression era. My baby boomers today, completely different psychosomatic makeup. They are, I want to spend as much as I can while I'm alive. And then there's about 75% of those baby boomers today that say, I do care about how much my kids inherit and how they get it, which is why we created something called the Living Inheritance Strategy, a whole nother topic. But they do care about how their kids get it. And then there's 25% of the people we meet, they're like, I could care less what my kids get. Matter of fact, I want to spend it all, and if they get nothing, that's fine. For the 75% of the people that do care, if you think about this, husband and wife, husband dies first, now the wife pays more because they're filing single, and they have all of the money that they have to take required minimum distributions on. Now, when they leave that to the kids, what are the kids' tax brackets? I have not seen, other than our Rothinator program, we actually put the kids' ages, date of birth, marital status, and we build the income tax plan for the kids. Because under Secure Act 2.0, since February 2023, you have to take an RMD. Well, clarify. It depends if the person that died is under 73 or over 73. We're going to assume they're over 73. So the kids have to take an RMD based upon the parents that left them the IRA. So if you say you take a $2 million, just as an example, a $2 million IRA, and you leave it to two kids making $100,000 a year, each kid gets $1 million. And let's say that the RMD is a minimum of 5%. But the problem, and I'll explain why this will blow up on kids. If you take $2 million, give $1 million to each child now has to take $50,000 a year minimum, and they have to pay ordinary tax. So if you're making $100,000 a year and now you get an extra $50,000 a year, that's going to jack up your income tax bracket. But here's the problem. If you only take the minimum distribution under Secure Act 2.0, you got to distribute 100% of that IRA by the end of the 10th year, which means that if you only take the minimum distribution at 5%, but you're making 8, the IRA is going to be worth $1.5 million. Now you got to take $1.5 million taxable all in 1 year. Now you're up with a 40% tax bracket. You live in, communist states like California and New York, and you're talking 60 to 65%. And so it presents a problem. So most kids would never take just the minimum distribution. They're going to take an equal amount so it doesn't hit them all in 1 year. Now, oppose that to a Roth. So let's say now it's converted. And let's say it's not $1 million because you paid the tax on it. Let's say it's $750,000 or $800,000. But now when you leave it to the kids, what happens is same rules. You still have an RMD if the parents were over 73. If they weren't over 73, wow, there's no RMD, and you can let that Roth sit there for 10 years, no RMD. You still have to distribute the Roth at the end of 10 years. So if you inherited 750, and now it's worth $1.5 million at 7.2%, which is the rule of 72. Money doubles in 10 years at 7.2. So you leave 750, and now it's worth $1.5 million. You can take that entire $1.5 million out. Well, you actually have to at the end of the 10th year, 100% tax-free. So in almost every single case where we run 3 levels, you're both alive, one dies, you leave it to the kids. When you add them all up, it's the amount of wealth that's being lost by people not doing this is massive.
So you work with physicians specifically. What makes high-earning doctors' tax situation different from regular business owners?
It's not much different, but it depends if the doctor is working under salary, which then it's hard to do a lot of tax planning inside the salary realm versus what we do on the investment side. Business owners, if the doctor is a practice owner, there's so many more things we can do because there's flexibility in how we structure the practice, the income, the asset protection, the benefits, everything. So it's not that doctors are, and people have asked me this before. I don't know. I wrote a book, 2016, The 6 Biggest Tax Mistakes That Physicians Make. And it was because I was finding that there was this pandemic going on with doctors and their lack of good advice. They're getting hounded by all the insurance salesmen and mutual fund salesmen, and they really weren't getting good advice. So I wrote that book back in 2016, and I guess for some reason, it just took off, and one doc refers another doc, and here we are.
So a lot of business owners thinks the IRS just has a set amount. A lot of business owners think the IRS just has a set amount they owe. No, this is questions. This one's screwed up. I don't know what I was thinking when I wrote that one. So let's say you say most financial institutions actually want you to underspend. Is that paranoid?
Oh, no. I've heard it directly from leaders of these big companies. One of the ways that they get to do this is something called a Monte Carlo simulation. This was something that was the Monte Carlo theory. It's a computer algorithm. It was actually invented in 1955. The guy that invented it, Harold Markowitz, he actually got a Nobel Prize for it. But the financial institutions have just hatcheted it up into a sales tool. So when you run a Monte Carlo simulation and you go to 9 out of 10 financial advisory firms or companies, they're always going to want to do the Monte Carlo simulation. What it does is you put your income in, you put your assets in, and then they ask you what your risk tolerance is, which is a whole other subject. And then they run the simulation. And here's what the simulation says. Let's say you're 60, it's going to run it out to 90. So you got 30 years. They're going to use an average rate of return on that portfolio. And then what they're going to do is they're going to come up with a simulation to give you a certain confidence level. Well, that's geared to have you not spend as much money because you don't want to see your confidence level go down and you have the potential for running out of money. But you got to question who's programming the calculator. What is their bias? What is their conflict of interest? And every financial institution, from a bank to a brokerage to a custodian, how do they make money? Retention of assets, float. So if you look at a bank, why does the bank now put a limit on how much you can take out on an ATM or how much you can cash out? They want to keep that money in there. They want to float it as long as they can. If you've ever had arguments about getting money out of institutions, insurance companies, the worst. Try to get money out of an insurance company. It's like, bending a rusty nail. Why? Every day it builds up their EBITDA and their float. So I don't think it's conspiracy theory. I think it's just basic capitalistic mechanism of how a financial institution makes money. Any way that they can hold on the assets, they're going to make money.
So you're launching a platform called Fitnomic in 2026, August 2026. What problem does it solve that couldn't be solved before?
Okay, good question, actually. So after 40 years of doing this, my wife kept coming to me and she kept saying, you owe to give back. Because I was mentored by the most fantastic person I've ever met in the world, smartest guy. His name is Bill Moore. So I give all the credit to him because it was literally boot camp for 9 years. He had a photographic memory, and everything I learned by him, from him, in whether it's tax planning, financial planning. So my wife kept saying, how do you give back? I'm like, honey, listen, I've mentored over 50 financial planners, and that takes a year to 3 years. And so I feel like I've given back. She goes, yeah, but what if you die tomorrow and everything between your ears and all the certifications and degrees and licenses and experiences, they're up in smoke because you can't pass all that on to a financial advisor, all of it. And it was very limited. Like if you look at somebody like Tony Robbins, he affects hundreds of millions of people. And my wife was right. I need to affect more people. And I didn't have a way of doing it. She said, well, why don't you write another book? I said, here's my problem with the book, even though I have another one coming out. It tells you what to do, but it doesn't tell you how to do it. Because you can listen to all these instructions from 15 different books and people just get information overload and they don't know what to do, the actionable way to do it. So when AI started coming out, I had this idea that maybe what I could do is hire some developers and they could follow me around and they could look at the casework. I could show them exactly what I do in every situation. And because normal AI is never going to do this, but what they could do is they could program the AI. They could condition the AI. Hey, if this happens, then here is what you look at and here's how you analyze it. And so this program that's coming out, and it's called Automated Financial Management. It'll be out probably October, November. We're hoping. We have the developers making the final touches on it. Essentially what it'll do is it'll connect all your different accounts into one single app, and then it will help you make all the decisions. But what most people do is they fail financially because they let themselves get overloaded with the decisions. Like if you think about today, you got 5 or 10 credit cards, you got maybe 3 to 5 bank accounts, you got 3 to 5 brokerage accounts, you got a 401k, you got benefits at work, you got a house, you got a mortgage, you got insurances. It's like this work overload trying to organize all this stuff. And there has been some people out there that have tried this, like Mint.com, Monarch Money, personalfund.com. Problem is they look at one singular category. But you and I both know that's not how our financial lives work. We can't just bring in credit cards and checking accounts and budget like Mint.com, because how do you know what your other alternatives are? You can't just say it's better to rent than it is to buy, or better to buy than rent. You got to have the analysis and not only the psychodynamic of how you feel about things, the location you live in, but also the mathematics. So literally every sphere of what I've dealt with in 40 years is now in this app, and people will be able to sign up and they'll be able to connect their accounts. And then this will help them make the decisions instead of them trying to figure out, who do I go to next to answer my questions?
So if someone's listening today and they say, oh, that Ken really sounds like he knows what he's doing, how do I get in touch with him? You would say,
well, just go to our website. It's One Wealth Map. One is spelled out ONE, wealthmap, MAP.com. And there's a contact us. And what we're doing now is if you just fill that contact out, say, hey, I want to get on the wait list for when that AI program, AFM, Automated Financial Management, comes out. We'll put you on the wait list. What we're going to do is give away probably the first 50 to 100 subscriptions of that as initial founders. But that's what we're doing now. We're building that wait list for that AI app.
okay, great. Well, thanks for coming on the show, Ken. I really appreciate it.
Okay. Thanks for having me, Zane.